All right, Sherwin-Williams just reported. Sherwin-Williams is a local company based out of Cleveland. We've always loved it. It's been around forever. It's been actually a pretty exciting stock, but they reported this morning they're actually the biggest loser in the S&P right now, down about 12%. So let's go to our software. And for those of you who subscribe to our software, I want you guys to pay attention here and go along. So one of the things we can do is we can go to news, and we can actually pull up their recent report. So this is on Zacks. So let's look at some of the major things that were reported here, okay? Because I know that people like to see the comparisons. Earnings surprise of a minus 14%. So they made 14% less money, which is not the best thing in the world here. Let's see here. Consensus estimate of 241. Of 281. But they reported $2.41 per share. Guys, that's a big miss for a company, okay? And the CEO came out and said, hey, we got a lot of supply chain issues. We got wavering demand. So I want everybody to remember this. This is the thing we're hearing a lot about. A lot of CEOs. Now, this could be a lot of jargon. Remember, CEOs might just say whatever they need to say in order to get the story across, to fit the story. But there is a lot of talk about demand being slower. And remember also, in our past videos, we've talked about consumer sentiment at the lowest level in history. Guys, imagine that. In the pits of the financial crisis, in the pits of COVID, people had a higher consumer sentiment than we have today. And consumer sentiment is usually a leading indicator of what's going to happen in the future. Am I saying we're in a recession? I'm not saying that. Am I saying we're going to go into a recession? Eventually we will. But the question you have to ask yourself is, if consumer sentiment is low, that is what people use as their determination of what they're going to pay, what they're going to spend in the future. That is a problem. So with Sherwin-Williams, this is their big thing. Over the last 4 quarters, the company has surpassed consensus EPS estimates 2 times. So it's not a huge number, but that's fine right there. They posted revenue of $5.87 billion for the quarter ended June 2020, but that missed by 2%. Okay? They did have increase, though, from last year of $5.38 billion. So you have to sit there and say, wait a second. The revenue's up, but they're being killed right now. Why? Well, when you miss, that's what happens. So let's go back to our Everything Money software. And oh my gosh, they're down 12.3% right now. $31 a share. So let's go look at the chart here. In the last year, they had a high of 354 and a low of 219. They're actually not even at their low yet for the year, but they're pretty close. Okay, let's look at the last 5 years, because I thought they hit 400, but the 350 was about their peak right there. COVID low, they hit 130, and right before the high of COVID, 194. Okay, so Sherwin is a great local company. They sell paint, they sell flooring product, they do a lot of things that are for home, and you have to understand, like, I guess you'd have to sit there and wonder what's going to happen to the company during a pullback. So let's go look at the income statement here. They did $20 billion in revenue in the last 12 months, 9.6 10 years ago. Let's go look what happened during the Great Recession of 08 and 09. All right, so 6.3, 7.4, 7.8, 8, 7.75, 7.18. So they did a dip here, but they rebounded very quickly within a few years. These are the things, and let's look at the profit here in those times. They never lost money in all those times. They're actually very consistent in their profit levels over those times. Yes, it was down from the peak, but that was to be expected. So what I'm trying to show you there is when you're looking at what could happen, go look at a previous recession. What happened during previous recession? And every recession is different. But the Great Recession hit housing very, very, very hard, where people didn't even have the money to go put money into their houses, which is what Sherwin would be relying on there, right? So let's go do an analysis or use our 8 pillars to look at Sherwin-Williams. So if you're new to this channel, this is your first time watching it, I'm Paul. I'm from Cleveland, Ohio, where Sherwin is, and I'm a value investor. My goal is to make long-term assessments on companies that I can understand and try to buy them at a discount. I don't follow hype. I don't worry about quarter-to-quarter results and if they hit analyst expectations or not. When I see this happening, so let's look at our 8-pillar process. If you're new to our channel, we use the 8 pillars as a screening tool to determine if we should go further on a stock or not. So pillar number 1, we want the 5-year PE ratio under 22.5. So right here on the main screen, we look at 5-year PE, and it's 34.65. That's a little high. Now, does that mean you avoid the stock? Not necessarily. If there's a lot of growth potential there, should be willing to pay a higher PE. Pillar number 2, we want a 5-year return on invested capital greater than 9%. So again, on this main page, 5-year return on invested capital, 13.8%. Boom. This means that they get a good return on the money that's invested in the business. So before we go to the next pillars, I want you guys to look. 1.1% dividend pays out $586 million. Now, for those of you new to this channel, don't just look at a dividend and assume it's safe. You have to compare the dividend to the free cash flow of the business. So just one line above. The average 5-year free cash flow was $2 billion, and last year's free cash flow was 1.6. So easily afford this. It's well less than 50% of the free cash flow, so I'm good with that dividend. All right, back to the pillars. Pillar number 3, we want revenue growth. I don't care if it's $1. I want revenue growth over the last 5 years. So we go to our income statement, and we look 5 years ago, 16.19, last 12 months, 20 billion. Check mark there. Pillar number 4, we want net income growth over the last 5 years. So we scroll down just a little bit on our software, 1.74 to 1.83, check mark there. Barely higher, but there is revenue. Now, net income growth. Now, I immediately go, wow, their revenue was up 25%. Their profit's only up a few percentage points. So I'm making note of that. Now, granted, profit can fluctuate greatly year over year, but I am making note in my head going, how is revenue up 25% and profit's only up a few percentage points? Pillar number 5. Now, guys, this is an important one because nobody ever talks about this. This is the silent killer in investing. Is the company buying back shares, keeping shares the same, or issuing more shares? If they're issuing more shares, they're diluting you as an owner. If they're buying back shares, they're giving you a bigger piece of the company without you doing anything. Now, it's not always great to buy back shares. It's not always bad to issue shares. On expensive companies, you don't want them buying back shares. But just our pillar right here is, are they buying back shares? So we go to the very bottom. The end of the 6th year, beginning of the 5th year, they had 277 million. Now they have 258 million shares outstanding. That's a check mark there. So they are buying back shares. Pillar number 6 has to do with debt. Debt works for a company the same way it works for you. If you and your neighbor are exactly the same people, same house, same job, same family, same expenses, but they have $10 million in debt and you have 0, you are going to manage the storm a lot better. Same with a company. So how do we determine if the company has too much debt? Well, what I've come up with is I go back to our main page. And I go to our 5-year average free cash flow, $2 billion. I multiply that by 5. So we want the company to have less than $10 billion of long-term liabilities. $10 billion or less. So we go to our balance sheet up here at the top. We scroll all the way to the bottom here. Long-term liabilities of $12.54 billion. So it's a little higher than we like. Is that a good or bad thing? I don't know. It's just a starting point, and it's not enough for me to go, oh boy, but it's not where I'm like, yes, this is awesome. Now, pillars 7 and 8 have to do with free cash flow. Free cash flow is cash from operations less your capital expenditures. You can do one of 5 things with free cash flow. You can pay dividends, buy back shares, pay down debt, invest in yourself, make acquisitions. You can do any 5, none of them, all of them, doesn't matter, any combination. So we go to our cash flow statement in our software. We scroll a little bit down. Now, guys, the reason the software is so great is all this math that you've seen and heard, I'll show you the shortcut to it. But even on the cash flow statement, we added this line here to make the math easy for you. So cash from operations less your capital expenditures. 5 years ago, 1.47. Last year, 1.66. Check mark there. And our final metric, just like PE, we want to assign a multiple to the free cash flow number that'll give us a market cap we want to pay. So we take this average free cash flow of $2 billion, and we multiply it by 22.5, same as the PE. And what do we get? $45 billion. So we want the market cap of the company to be under $45 billion. So we go back to our main page on our software, and the market cap is $58 billion. So that's an X there. Has a little bit more to go. Now, like I was telling you guys, 8 pillars tool right here. So we're going to use this data. This is all here on every stock. We're going to use this data to then put in our stock analyzer tool to determine what to pay for the company. But just like I said to you before, this is all the data here. Couple X's, the debt, and the earnings multiple and free cash flow multiple. But again, we don't know if that's good or bad. It all depends on the growth rate of the company. So we go to our stock analyzer tool. Now remember, guys, on the stock analyzer tool, every investment's the present value of all future cash flow. We don't know the future. We have to make assumptions about the future. That's why you'll always hear Warren Buffett and Charlie Munger and myself and other value investors say, I avoid the company if I can't determine how much money they're going to make. But if you look at their income statement here, over the last 10, 20 years, it's a very consistent growing number. So we can make some sort of reasonable guess as to what they're going to make over the next 5, 10 years. But my goal is to be conservative. So let's start with a 10-year assumption, 10-year analysis. You can do upwards of 20 or as low as 1. So I look at the 10-year numbers here, and their growth is slowing. Okay? So obviously the 1 year is a fluke, but I'm going to go conservative. I'm going to call it 2, 4, and 6% revenue growth. Okay? For my profit margin numbers, they've basically been around 9% since the beginning of time. So I'm going to go 8.75, 9, and 9.25. Free cash flow. It's a little bit more sporadic, but I'm going to do 9.5, 10.5, and 11.5. Actually, you know what? I'm not going to do that. I'm going to do 10, 10.5, and 11. Now, PE and price to free cash flow. Guys, they're currently at 31 and 34 in the last 1 year. The average company in the history will be about 15, okay? Sherwin-Williams is an exciting company with a great moat. If you ask 100 people who makes the best paint, I'm sure you're going to get the vast majority to say Sherwin-Williams. So it's got a great moat, but it has no growth. It's a very tough company to grow. Why? Because it's so big already. So I'm going to go 14, 16, and 18. And the reason I hesitated there is I'm giving it a good premium as the low end because of the moat. I mean, it's a good brand. And then finally, for my desired annual return, I'm going to do 12.5%. Why 12.5%? Well, you can get 9 or 10% from a long-term ETF. So give yourself some margin of safety and a reason to buy the stock. Now, when I hit this analyze button, it's going to give me the present value of all this and what I should pay for the stock today. If it's all green, does that mean go out and buy it? No. It means, great, go do research. Go do more research and make sure your assumptions here are correct. Join our community. If you join our community at everythingmoney.com, you can have a conversation about Sherwin-Williams with the thousands of people who are active every single day in that company. And I guarantee you, based on this happening right here, it's going to be a topic of conversation in our community. Since we've started talking, since I started this video, Sherwin-Williams has lost $500 million in market cap. All right, so once I hit this, and if it's all red, if it's close, add it to your watch list because we have a watch list here. So I'm hit the analyze button. 223 is the current price. And like I thought, based on these PEs, it's got a long way to drop. Low side of 80, high side of 145, 150, in the middle around 100 to 110. So my suggestion is be a little patient, have this on your radar because it's a great company to own at the right price.